Well, good morning or good afternoon if you're on the East Coast. Welcome out to the Trading Coaches Playbook. My name is Tony Benson. I'll be your guide today. Are y'all ready to have a little fun? Can y'all hear me loud and clear? It's not? Okay, good. I'm going to make sure I didn't mute it. Hopefully I can keep this cough at bay. It's still kind of lingering a little bit. But I got my little box of Altoids here, which seems to help it a lot of times. But sometimes just talking, a little vibration gets a little tickle there. So, hey, Kevin, thank you. Hey, Jim, how we doing? Good to see y'all. I see a lot of familiar names. I see some new ones too, which is always nice to see. Welcome out if it's your first time. Before we get too far into this, let me get the disclaimer out of the way. We are net registered broker-dealers, investment advisors. I will not give you any recommendations or advice. Everything that we do here is purely for educational purposes. If we do talk about a trade, just assume that it is a paper trade or a practice trade. For regulatory reasons, we do not discuss funded trading here. So, camera got adjusted a little. Hey, Gills. I think that's how you say it, right? Isn't it Gills or is it Gillis? I want to make sure I pronounce it right. I thought it was Gills, but number one or number two, I guess is the question. Gills for one, Gillis for two. Or do you care? I know I don't care. People call me Anthony. I think I'm in trouble. Okay. I'm assuming that was a typo. All right. Here's all the stuff that's coming up this week. The premium online workshops, the one trade away challenge is the 7th, just 3 days away. That's Monday, 8 p.m. Eastern time. Monster Market Movers is the 9th and the 23rd. Inner Circle is February 16th at 8 o'clock Eastern time. Trade You is February 17th. That's a couple weeks out. And Patterns in a Flash, February 18th. Clarice helped me out because I have a Patterns in a Flash class today on my calendar for 1 o'clock or 4 o'clock Eastern time. So correct me if I'm wrong. If I'm not doing, I thought I was doing my Patterns in a Flash class today, right at the market close. So I was going to say that's a good opportunity for a lot of you if you haven't been in that class. It's a stupid little bug. If you haven't been in Patterns in Flash, just this afternoon in 3 hours, I'll be doing or let's see, is that 3 hours? No, 4 hours. I'll be doing. I'm supposed to. At least I thought it's on my calendar for doing a 1 hour class for Patterns in Flash subscribers. So awesome. Thanks, Clarice. She just put the link in there. So that is it. If you haven't seen Patterns in Flash, it's a tool I created. That's the purpose of it is to train you to recognize patterns and know what to do with them, how to trade them. But then twice a month, we do a 1 hour live class, just like we're doing now. But obviously it's exclusive for subscribers. So, but as most of you know, you can get a 2-week trial, right? And that's what the link is. Clarice just put in the chat. If you click that, you do the 2-week trial. You can come join me today at 4 o'clock Eastern time, I believe. Again, I'd like to actually, you know what? I just remembered it is. I'm pretty certain either I'm crazy. Today is February 4th, Friday. I don't need Clarice. Sorry, Clarice. I forgot this was here. So this is the calendar on the Wealth Builders site. Patterns in a Flash, 4 o'clock Eastern time. Today, February 4th. There's my confirmation. So I'd forgotten I had that up there. And so come join me. We'll have a little fun. We'll probably just continue to talk about what we're going to talk about for the next hour or so. The rest of the stuff coming up, Mastermind Group, Tuesdays, 8 to 9. And then the free online workshops, of course, Power Hour, Trading Coaches Playbook, the one we're doing now every Friday. Market Mornings with Rob is every day. I've got the Power, February 10th at noon and 8 Eastern time. And then, of course, Power Option Plays every Tuesday and Saturday, Cover Call Explorer Thursdays, and E-Mini Think Tank with Brandon Monday, Wednesday, and Thursday. Of course, you can follow us on all the different social medias. You see them all there. And then, of course, Rob's one trade away challenge. You can get into that for just $49. And that is a steal, absolute steal. So here's what we're going to talk about today. Inadvertently pretty appropriate. I guess maybe not inadvertently, but it's certainly top of mind of a lot of folks, including myself. And dealing with and managing the volatility in the markets is especially with how crazy it's gotten in the last, well, this year, basically the last 5 weeks. Volatility can be challenging, especially if you're trading options, right? Because the implied volatility that's put into the options is a big factor of how they're priced. So if you buy them at the wrong time, the stock can actually move in the direction that you expected it to, and you can still lose money. That is one of the tricky parts to trading options, is that one little factor that you've got in there of the volatility. And when volatility spikes like it has recently, they add a whole lot more fluff into the options, right? So an option today, I don't know where we're at. Yeah, we're still pretty flat. Options yesterday, I don't know if you all watch the market, but obviously you can see it behind me. It was tanking yesterday. And when it drops like that, an option that was going for $5 might run to $6, but then they add the volatility in, which makes it $6.50 because the fear factor's there. And so when you're going to trade the downside, and this is one of the reasons I wanted to talk about this today, is that with the market dropping like it is, if you get in when it's tanking, you're probably going to pay more for the option than if you waited for it to bounce a little bit. So typically when I see things, when the market's dropping like it is, like it has been, I usually will wait for it to bounce a little bit and move back higher before I start buying puts. You know what I mean? So if you buy it in the middle of the spike to the downside, the volatility has spiked and you're going to pay a little bit extra for it, which if it keeps tanking is not a big deal. But if it doesn't, it bounces, then it's a problem, right? So volatility can be dangerous, right? Some of you have experienced that. Excuse me. Okay, good. Will's not here. Not yet. He might come in late. I always feel bad because I'm not really picking on him, and I know he's a big boy and he can handle it, but he had a situation I point to often, which I've experienced myself. I'll bring it up on the chart and show you in a little bit. So volatility can be dangerous and beautiful, right? One of the reasons that I love trading the downside, this market tanking, I absolutely love. I know it freaks a lot of people out, and if you're a bull and that's all you trade is the upside, then you don't like this market. If you play both sides, or if you're a bear, you love this market. One of the reasons I love trading the downside and I love situations like this is because if you buy an option, right? I just explained how volatility spikes when it's dropping. It works against you, right? If you buy at the wrong time. But what happens if you buy it at the right time? What happens if the stock's going up and you buy it when the volatility is low? Now, when it drops, or if it drops, now you're getting the flip side of the coin, right? Now, when the volatility spikes, you're cashing out at a higher price because the volatility is spiking. So you're taking advantage of that fear factor. That's one of the beauties of playing the downside. You capture that extra volatility as extra profit as people are getting more and more scared. As the fear factor kicks in, they add more fluff to it. Now, which side do you want to be on? You want to be on the side of paying extra fluff, or do you want to be collecting the extra fluff as premium and profit? One for yes, two for no. It's a stupid question. You don't even have to answer it. I already know the answer, right? I mean, who doesn't want to be on that side? That's one reason I love the downside, because you get that volatility flip, right? It is, and volatility is essentially a double-edged sword. It can work both ways. Just like I said, it's either, and I've kind of already talked about how to avoid the bad edge, right? If it's tanking, wait, even if it's waiting for an intraday bounce, even if it's just a little bounce intraday and they take a little bit out. So, and realistically, it all comes off the chart, right? If the chart gives us an indication that it's going to continue to tank, it's not necessarily bad if you're overpaying for it, right? There's that old saying that buy high and sell higher. Well, if you buy an inflated option and it continues to fall, then you obviously are going to sell it at a more inflated price. So it's not a bad thing. And that's the tricky part, right? The double-edged sword is, which side do you want, right? You want to be on the right side of the sword. So ideally, the perfect situation is for volatility to be low. You load up on puts and then it tanks and you take advantage of that flip. If that's not the case, if the chart doesn't lead to that and you have to buy it while it's high, hoping that it will get higher, then obviously, you pull the trigger. And again, it's all based off of the chart. What does the chart say? And speaking of the chart, we're going to jump there right now. In fact, if y'all have tickers you want to look at, if y'all have charts you want to analyze, you want me to analyze and tell you what I think, then send them in. I will look at, well, these are ones that I just, you know what, I'm going to do a really quick update on this intraday, just so we have a little more accurate time. And I've also got my real-time charts running. We'll see. IBM was fun this morning. And this is one example of why being able to recognize patterns and see them on the right side. This is where patterns in a flash comes in. Absolutely, Kevin. Give me just a minute here. So IBM is one that this morning made a nice little double top. Let me go. I think that one on the bottom. Yeah. So the bottom chart here is a daily chart, and you can see that. And this is what's tricky is, you know, I have two different machines, right? The machine you see behind me is my trading machine. That's all I do on it. I trade. I don't do business. I don't do coaching. I don't do emailing. I do nothing on that except for trade. That's all it's dedicated to, 100% trading. So the one that I'm doing the web shop on is the one we're seeing here. So the drawings don't translate over most of the time. So IBM, you can see is at a resistance level. I was tempted yesterday to buy puts on it, but it's been going kind of counter the market. And I already played some puts somewhere in there. I don't even remember. It's been a little bit, but when it came up and hit that high, I remember playing there a little bit. And I didn't make a ton, but I made a little bit, just a small profit. Perfect, Robert. Apple and Microsoft, two I want to look at too. But IBM was one that I played this morning because we've got the double top, right? We've got that high coming in. In fact, we can move this up to right there. We have a chart, a thing there, and this was just simply a day trade looking at, okay, if it made the high, it made a double top, it hit it, and then we've got the shooting star, right? And this all comes down to, once again, recognizing the pattern. I see a double top starting to form. We've got a resistance. If it rolls over from here, we've got a double top. Beautiful. So looking to trade the downside and put a target. I think I put it down. Actually, you know what? I know exactly where I put it, right here. And of course, like I said at the beginning, if we're talking about specific trades, just assume it's a paper trade or practice trade. Whether it's real or not doesn't matter, right? It's all the same thing, kind of. I mean, practice trading is great to learn the mechanics. You don't get the emotional side, which is the challenging part of trading. But for regulatory reasons, we don't talk about funded trading. I wish we could a lot of times. So if you're not familiar with how I trade, this is how I do it. I look for a pattern. If I find a pattern, I say, okay, where's the resistance? Where's the support? What do we look like? You analyze everything, right? You look at the volume. You look at, if you use indicators. I don't really use indicators very much. I didn't even look at them on this. I just saw the double top starting to form. I thought if it rolls over, then great. And the shooting star right there is another dead giveaway that we're probably going to roll over from here. So I put the resistance in. I put a stop. Say, okay, if we break out and make a new high, I don't want to be there anymore. I'll take my loss and move on. I have day traded IBM before, and it can be wild and crazy and move very fast. So I don't mess with it. It's one of those things I put a hard stop and say, get me out if it hits, because I don't want to be there, because it can run. Well, you can see how fast it can run. I mean, here yesterday was 137 to almost 139 in 35, 40 minutes. So if you were in right here and you didn't stop out, and it takes off like this, you're getting crushed. So it's always good to get out, and you can always get back in, right? If it redevelops, then you can get back in the trade. So this is literally how simply I trade. Found a pattern, double top starting to form, a shooting star, looking for it to drop. Stops up there, targets down here, based on a 3-to-1 risk reward, which is that right there. So I've got 65 cents of risk, $1.95 of potential reward. So if I short the stock, I'm obviously looking to play the downside. Yeah, that's a 5-minute. The top chart is a 5-minute chart. In fact, let me blow that up and make it bigger. So it's, I know it can be a little scrunchy, but basically what this does is it shows me I have 3 times as much risk as I do reward. Why not, right? I mean, that's what you need to have. And if you're not familiar with risk reward and the benefit that it has, then Go watch the video on risk reward and the bonuses of patterns in a flash, and you'll see why. Because it literally will put you in a position where you can be wrong 70% of the time and still make a profit. And if you think I'm crazy, go watch the video. Trust me, it's nuts when people see it for the first time and they understand it, because it's just simple math. It's mind-boggling. And honestly, if you utilize it, it will. And like I said earlier, one of the biggest challenges to trading is the emotional side, right? Paper money is fun, and you can learn strategy and learn technique and technical analysis, all that stuff with paper money. But the emotional side of trading is what's difficult. So if you utilize 3-to-1, then it gives you a dramatic advantage on the emotional side of things, on how to manage your emotions and keep your mind straight, right? So this is an opportunity, basically just looking at shorting the stock at 138.21, and it just fell off a cliff. It just kept on going. And I kind of jockeyed in and out a whole bunch, but it was a good move. So, and I don't, I don't have that there, but I was gonna say I'd show you the profit, but this is the simulated trading account here, but I actually did this as a fun to trade. So, and it was a healthy profit. So I didn't do a huge position. I think I maxed out at like 300 or 400 shares. And I was getting in and out with usually 100 shares at a time. Well, I think I got 200. I think I started with 100 at like 138.50. I thought, I'm going to jump ahead of this a little bit. And this is what I like to do. Again, if you're not familiar with, this is what I love to do. So IBM's here, and I'm watching it start to fall right here on this bigger candle, right? The first one after the shooting star. It's starting to fall. And I looked at it, I said, you know what? I'm going to get ahead of this, which is aggressive, right? Because it really hasn't made a move down yet. It could just continue to rally. So it's very aggressive to get in here. But a lot of times I'll pick up, or I'll start a position with just a really small part. 1 contract, 2 contracts, 3 contracts, 100 shares. In this case, when I day trade, I'm doing stock. So that'll answer your question, Kevin. You could do weeklies. You could do options. When it comes to stock, for the most part, I just do straight stock, just because liquidity, the spreads are smaller. IBM is one I probably could do options on because the spreads are probably small. I haven't, like I said, it's been a month or two since I traded it, the options on it, but some stocks you could day trade with options, the spiders, which is leverage, right? It's a double-edged sword. There's like volatility. So you can make, I probably would have made a lot more if I'd have done an option here. But, north of 350 for an hour's worth of work is not too shabby. So I'm not complaining. But what I did is I picked off just a little tiny position right here, just 100 shares, and then put an order down here so that if it gets down here and adds to my position, I'm already ahead a little bit, right? If I shorted at 138.40 and it gets down to 138.21, which is where my entry is, I'm already ahead $20. I mean, if you're doing 100 shares, you're already ahead $20. So now when you add to it, even if it turns around and backs up a little bit, you're still okay. So I love to get in just little time, dip my toe in the water, if you will, right? You don't walk up to some strange pool and just dive in head first, do you? You stick your toe in there. Is it warm? Is it cold? Is it freezing? I like to stick my toe in the water. Is it warm? Hey, it's warm. Let's go. And then dive in. All right. So make sense? But there's the thing, and there's one thing I wanted to bring up. This is where I was planning to start is let's see. Okay, he's not here. Like I said before, I always feel bad that, when because Will got beat up pretty bad on this. I don't know how many of you are familiar with Car. This is Avis Budget, right? This is a rental car company. I'm not a fundamental guy. I mean, I understand fundamentals and, a basic, a very basic level. I don't utilize them for short-term trading, for longer-term stuff. But it's really hard for me to fathom that here's a stock. I don't know how long has it even been around, since 2008. Okay. So since it went public in 2006, the highest it's ever gone was $68. And then this year, you can see it's basically just, and for the most part, it's averaged about $30. I mean, over the last decade, This thing's been right around, it drops, the COVID crash dropped it to 10. It's been as high as 50. Right in the middle there is kind of where it's saying. I'd say the median price has been about 30, 35 bucks. And then the COVID crash hits here, and then it starts to trend higher, starts to recover. And then in February, March of last year, started a rally from 50, went all the way up to 100. Let me get back in here. And you can see it. It's hard to see with that big old spike on there. In fact, let me make it logarithmic. There, that helps it a little bit. So you can see there's the COVID crash, right? It rallies back, comes back up. Okay, it's okay, and things are moving higher. And then people are getting wind that they're selling all their used cars, right? Because they're just sitting there. And they're getting rid of stuff. So they're actually putting money in the bank, which is good for most companies, right? Excuse me. We run up and hit basically this $100 level. And then in September of last year, it breaks out of 100 and runs literally to 180 bucks. It was about 90. It basically doubles in a month and a half. Give me a second, Rob. Or Robert, I don't know what you go by, but. And then earnings came out, and that huge spike is earnings. Zoom back. This is the day earnings happen. And just alert. If this craziness right here, and this is stuff that we've been seeing, the whole meme stocks, all the retail traders, there's all these signals that are coming in showing that this market is top heavy. Tons of it, right? The last trader, the playbook, coach's playbook that I did, we talked about that. This is another clue. The thing literally comes out with earnings, opens at 170 bucks, and I think it was 45 minutes later, if I remember right, hits 550. Totally insane. There's no way on planet Earth that a rental car company is worth 550 bucks a share. I don't care fundamentally how good it is. It's insane. So it starts to drop back off. Well, what happened is somewhere, I think it was around 450, 475, Will went and bought a put. I know he's okay with me telling this. Even though I always apologize to him, because he bought a put somewhere up at like 4.25, 450, and it dropped all the way back to 300 intraday, and he's still losing money. It dropped like 100 or 150 points, and he was still losing money. If that makes you scratch your head, it's called volatility. Right? That's the craziness of volatility, especially when you get insane stuff like this happening. And this is what you have to be cautious of, because the spread was huge, right? The spread was ginormous. If the spread is big, there's usually a reason for it. Either it's a really illiquid stock, which isn't necessarily good. If it moves in your favor, it could be great. But if it moves against you, it could be really, really bad, right? Again, the double-edged sword. And I remember witnessing this back in 2008 when the market started to crash then. I've seen it a couple of times. I think it was Morgan Stanley one day. It gapped like 8 or 10 points, which back then was big. I don't remember what the price of the stock was, but it was a huge move. The one I remember the clearest, I still remember where I was sitting too, in an old house, was the spiders. It gapped down 12 points. And again, that was like an 8 or 10% drop from where the spiders was then. Now, it's 400 now. It was like 100 or something back then. And I remember looking at it going, I think it's going to bounce. I should buy some calls. I went and looked at it, and the spreads were big. And I went, you know what? Something in my gut just said, nah, that's not there. And I sat there and watched it. And in the first 30 minutes of the market, it retraced the entire gap. And the options that I looked at buying, that I almost pulled the trigger on, were lower by 50 cents. It was insane. I remember sitting there just shaking my head going, wow, that's crazy. Now, if you go deep in the money, obviously that would change things, but I didn't. I wasn't even looking at that. I don't even remember which strike they were. I remember looking at him saying, that's insane. That the stock ran 8 or 10 or 12 points in 30 or 40 minutes, and I would have lost money on it. And that's the double-edged sword of volatility that you got to be cautious of. And that's exactly what happened. And Will learned a valuable lesson here. Even though it wasn't fun, it was a little bit expensive. I don't think he took a huge hit on it, but enough to stick. And I've had enough of these over the last 22 years that there's no doubt that in 22 years, Will remember this one very clearly, and he'll describe it to you just like anything else, right? So let me get to, I'm going to start on here. You'll have some stocks we want to look at. We'll look at W day. Before I do that, let me grab Rob's question. I keep calling you Rob. I don't know if you want Rob or Robert, but how did I pick the entry point on IBM? Simple math. This right here. Because the first thing I do, and this is a nice, very clean, clear double top, right? It's out of resistance. It's forming a double top. The candlestick pattern, the shooting star, everything right there says we're probably going to head lower. And if we do, I want to be there. Okay, thanks, Robert. So the resistance there is 138.64. The first thing I do is put a stop in. There's always where am I going to get out if this thing goes against me? That's the first step. So I put it right there just above the high of the day. I think the high was it was 82, 138.82. So I put it just a few pennies above the high, which says, get me out. The target I put down here at the, not quite at yesterday, you can see where it dropped off really quick and then bounced, and it bounced here about 136. And crazy enough, well, I just trailed this down, but that happened to be where I put the target is right there at that previous low. And from there, so it's just that. First thing is stop, then target. The entry point, like I said, is simple math. I put in the stop at 138.86, target of 136.26, and that spits out this number, which is 138.21, which gives me 65 cents of risk, right? It does the math for you, calculates the distance from the entry point to the stop, which is 65 cents. And then the distance from the entry point to the target, which is about 95. That way, let me just explain it simply. If you utilize a 3-to-1 risk reward ratio, say you do 4 trades. The first one you lose $1 on, right? You do 4 trades, you're going to make $1, or you're going to make $3, or you're going to lose $1. Okay, and this is all in the video when I show it visually, but I'm going to try to do it quick in case you haven't seen it. You do 4 trades. You lose $1 or make $3. You lose $1 on the first trade, lose $1 on the second trade, lose $1 on the third trade. You've lost $3. Your fourth trade goes in your favor. You make $3. So you've lost 3 and you've made 1. You break even, right? Out of 4 trades, you were only right on 1. Only 1 went the way you thought it would. 1 out of 4. What's your batting average? 25%. You're 1 for 4 and you break even. So if you can bat 250 and you utilize a 3-to-1 risk reward ratio, then in the end, the law of averages say you're going to come out even. So if you can bat 300, if you get to 30%, you can get to 35, 40, do the math. It's just a matter of odds. And so I utilize 3-to-1 for that reason, because now I know mathematically, statistically, that if I'm disciplined and I stick to my plan and I have 3 times as much upside as I do downside, in the end, I'm coming out ahead as long as I'm batting 300 or more. It's not much different than baseball, right? What's the difference between a 290 hitter and a 300 hitter? Hall of Fame, right? True, Amos. And that's a good point. It says if the numbers are static, but that's why I also said over the long term, because in reality, some days you're going to do, you might trade an Amazon that moves 300 points in a day. And then you might trade an Alcoa that moves 2 points in a day. But law of averages over the long term, you should come out ahead, right? If you're sticking to the plan, that's the key. So, but does it answer your question, Robert? That's how all my entry points come this way. They all are done this way, which is where's my stop? Where's my target? It's just simple math now. Now, like I said here, do you have to stick to it? Not necessarily. I like to get in a little bit ahead of it. I love to dip my toe in the water. And in this case, it worked out beautifully. It doesn't always. Sometimes I get in here and it turns around and stops me out. But here's the beauty of that. Say I get in at 138.50 here. I just stick a little tiny position in. Versus 138. Say you get in at 138.20, it turns around and stops me out. I got hit for 65 cents, right? If I get in at 138.50, now I've only got 35 cents. I've got half as much risk by getting in a little bit early. By sticking my toe in the water a little bit early, I have less risk too. So if I stop out, it doesn't cost me that much. And it's a small position. But if it does move the way I want it to, then I'm a little bit ahead of it, which gives me higher profit potential with also less risk, right? Yes, kind of, Amos. Kind of. You got to qualify that. Because once you're in it, it's a lot easier to add to it. Until the woulda, shoulda, coulda syndrome kicks in. You say, I should have bought more. Bought puts on Apple yesterday at 280 or 290 or something like that. And today they're going for like 350. I'm like, I don't want to pay more. I should have just bought more yesterday. Right? I should have just bought a bigger position yesterday. But it is what it is, right? You just have to go with the flow. So, all right, let's get to work day now. I haven't seen this for a while. Ooh, y'all see that? If you don't, this is why you need patterns in a flash. That should jump. That just jump off the screen at you right there. There's a big head and shoulders. This was the purpose of patterns in a flash, because when I started, I couldn't see them like that. And there you go. There's why you learn patterns. I mean, it's just crazy. I have not looked at working day forever. And that's the beauty of patterns. It's just, it literally just boggles my mind still. I mean, I've been at this almost 22 years. And like I said, I mean, I have no lines on this thing. I don't think. Nope. There's nothing on here. I haven't looked at it. But you come in and see a head and shoulders, and that is the measured move, right? That red line that I put on at 43.25. So you measure from the neckline, which is that line, up to the head. If it breaks the neckline, that's about what we expect it to move. What did this one do? It pretty much tagged it pretty close to the dollar. So, but the key is, obviously, you have to see it. I mean, right now, and literally, this is exactly what happened to me. I'd see something like this on the chart, and this is when I started, right? I was reading books, and back then, that's what we had. We had books and live workshops. That was it. There was no web shops like this. You didn't have any. I mean, we had charting software, but excuse me. And this would happen to me all the time. I'd finally find a pattern. I'd learn about it, study it, look for it. I'd finally find it, then go like, I can't do anything with it. That's a $40 move on a $270 stock. That's about what, 15% or so? And if you're trading options, generally speaking, you're getting, for each 1% move in the stock gets you about 10% move in the option. So a 10% move in the stock typically will yield about 100% move in the option. And there's a lot of variables, so that's not a hard and fast rule, but it's kind of a general rule of thumb. So you get a 15% move in the stock, you're looking at 150% return on your option here. But it's too late, right? It's already moved. But again, that was the point. This was where the flashcards came from. If you haven't seen the flashcards, now let me just real quick. I'll show you just so you know. And again, this is where this whole tool started from, was flashcards. And well, there's a head and shoulders. Let's take that. So all you just log in here and you click on them, and just like flashcards with math, right? It's just a training mechanism. You can sit here and click. It's on a timer too. You can sit and just watch it. But the whole purpose is to train your eyes to see the patterns on the right side of the screen. That's what it does. So what to do with this now is the big question, right? I'm sure that's what you're at. Who asked that anyway? Oh, Kevin. What to do with it now is the question I'm sure you're thinking of, right? Where do we go from here? What have you done for me lately? And this is where I usually back out and look at the big term, big picture. And I just look to put major, in fact, let me get rid of those. I'm just looking for major support resistance levels. And this one, obviously, there about 220, 222, it looks like, is a solid spot. That's where it topped out before it dropped. And then it kind of danced around to here. Let's see. Yeah, I'm going to move this up a little bit to right there. And that's one thing, too. While you're drawing lines, you can see where I had this originally. There's more closes on it, right? And I use a line chart. But then I'll go to candles and adjust it a little bit where you catch the intraday moves. Because the more you catch, the more solid the support level is, right? And there's one important thing to remember with support, resistance, and trend lines is they should be drawn with a crayon, not a pencil. So don't get so nitty gritty. For those of you that are engineer thinkers, if you get down to the exact penny, you're going to struggle. It's more of a range, kind of a space. So sorry, at least I hit the mute button this time first. Okay, that's fine, Amos. No big deal. We all have work to do. So what now? There's where it's kind of stuck in between, right? We got the resistance there at 246. We got a support at 222. And then earnings, are they coming out? That says 223, which is 19 days from now. But the challenge with this, and I don't trade something when it's in the middle of a range. I will look for this thing to either rally back up and look for some kind of signal. If it looks like things are going to go north, if it breaks out at 246, then I'd be looking at bullish. I wouldn't get bullish on this unless it broke north of 246. Because you can see there's some solid, what was support. It broke it. It did get above it here for a day, but the market's dragged it down. So if it breaks above 246, then I'd be bullish. If it stalls out here at 246 or even 250, which is a good round number, right? If it stalls out there and starts to turn back over, then I'd be looking at a bearish play. And I'd be looking at it probably dropping off to about 222, somewhere to that, back down to this area. So from an analysis standpoint, that's what I see. Like I said, I don't get in the middle of the range here. I wait for it to get to a support or resistance, a major one, not little tiny ones. And you could, I mean, if you're really thinking this thing's going to go north, then you could set up a trading plan and say, you know what, I'm just going to get a little bit, dip my toe in the water here. It's an option, obviously. I mean, you can do whatever you want with your own money, but you could pick up an option, you know, maybe even say, you know, there's a little support here. If it's above 241.50, pick me up a small position. And then if it does break out to the upside, then you're ahead of it and you can add to it. Make sense? You're welcome, Amos. I'm not even sure what I said to open your eyes, but you're welcome. But honestly, it's nice to hear that. Something I said triggered. What about the trend line coming down from the top? I was just going to say that there is definitely that downtrend as well. So good eye, very good eye. That's something to combat with too. And we could look at indicators on this. We will. There's moving averages. And I don't use indicators heavily. I mean, it's a tiny percentage of my decision-making process. Nothing there with the moving averages or Stokes. MACD is not really showing anything. Usually what I'm looking for with MACD is divergence. And I'll show you what I mean if you're not familiar with that term. You notice the highs on the price chart are getting substantially higher in this case, and MACD was lower when it peaked out here. So they're going opposite directions. And that is usually a warning sign. It's maybe not the best analogy, but if you're laying in the hospital bed and they've got all the things hooked up to you, measuring all the internals, right? And something on the screen goes off, says, you know, something inside's going on, even though you may be talking and everything's normal, something's not quite right there. And that is essentially what MACD can show. If it's diverging like this, then it typically means that something is internally, something's going on that you can't see yet. And it's fairly common that the stock will eventually catch up and follow what MACD does. And you can see here, this is a perfect example. It doesn't, like everything, it doesn't happen all the time. But let me get rid of the neckline there. So just for fun, so y'all can see, and I know this will kind of go back to Robert's question about picking the entry point. So let's just say we're going to play that. We're going to treat this as if it's going to break north of 246. So first thing I'm going to do is if we're assuming it's going to break north of 246, the first part is where am I going to put a stop? And I'm usually looking at, when you look at the support levels, I'm looking at, okay, where approximately, I mean, you've got a bunch of intraday dips down here and you don't want to get taken out too early, right? Because then it has the possibility of turn around and taking off. So picking stops can be challenging, right? And especially on volatile stocks, because where do you put it? You got this one day where it dipped down below it, especially if you're using a hard stop. So I'm going to ignore this day, but all these other 4 or 5 or 6 days where it dipped down below there, but then closed higher, I'm going to put it right about there. So now, and I just color code these that way. I mean, I already, whoops, that's not what I wanted. That's okay. So the target, and actually this is the way I would figure the target is what's our range. If you haven't noticed on charts, you will see that a lot of stocks trade in ranges, and the ranges are almost always the same. So we're going to go right there, which is pretty close. It's a little bit shy of it, but you see some resistance here. Back on the left, you got a little support right here. We're kind of dug in. It's bounced here a few times, kind of in the area. So now I'm going to put the target. I'm going to remove that. I'm going to put the target just shy of that. In fact, I'm going to go right off that wick. Put it right there. And then we'll make that green. So now I've got my stop in place. And again, this is if it breaks higher, but just so you can see the process. So if it breaks higher, I'm going to get out of it if it rolls back. In other words, if I get in and it moves against me, I'm getting out at 243.25. And then my target is going to be 265.14. 243.25. Now this is going to spit out an entry point for me. I don't even have to pick my entry point. I don't have to say this is where I'm going to get in. This is where I want to get in. But that gives me $5.47 of risk and $16 of upside. So I'll duplicate that. Paste the number in there. And I just made this orange because it was the only other bright color that really worked. And the yellow and all that other stuff doesn't work. So now I have a simple trading plan. I have my stop. I have my target. And now my entry point is 248.72. So if it gaps above that level, I'm not getting in. If it gaps to 255 tomorrow morning, it's too far away. My risk reward is out of whack. I'm not going to do it. Now, if it pulls back to 248.72, then I'll see what it's doing at that moment and take it from there. But if this thing just runs north and starts to go, then my entry point is 248.72. But like I said before, can you jump in here? Could you get in right here with a small position, anticipating that it runs? You could. It's just about how much risk you want to take, right? So, and we're looking at Apple and Microsoft. Apple is, so there's Apple, and you can see I've already done this one. This is actually the plan that I'm trading off of. Let me get back to the screen one. And here's why. And this is where the vast majority of decision making should realistically come off the price chart. That's why I don't use indicators much. I mean, you can see the indicators. Do you know what these all are? We look at MACD, right? There's the 9, the 12, the 26. Those are all mathematical calculations from past price history. So they're delayed, if you will. That's why I don't like the term leading indicator. I mean, I understand what it means and why people use it. I'm not a big fan because the past can't lead what is happening now. The most accurate, the most timely indicator that we're looking at right now is the price. That's where 90 to 95% of my decision comes from. And the rest, most of the rest of the decision is off of volume. And you'll notice here, again, a nice double top, just like with IBM, right? A nice double top on IBM. The first peak here, we had a dark cloud cover show up. So we've got a candlestick pattern confirming the resistance. We come back up, do it again. And that's pretty close to a dark cloud cover. And it drops from there, tries to retrace some, but then it sells off, and it sells off with increased volume, which is an indication of momentum, right? So it tells us that people are selling this puppy. Not as big as some others, but people are getting out of Apple. Of course, they came back in buying here. And now it's rallied back up. And you notice the last few days, we had a couple of days of big volume. Well, that was after earnings. So you have to attribute that big volume spike to earnings. But look at the last few days, how big the volume's dropped off. The last 3 days, and that last candle is today, volume just dried up here. And we got a little hangman, right? We got a 2 or 3 day rally, hangman kind of, it's not textbook, not beautiful. And then a sell-off from there. And so I remember looking at this going, you know what, this little high right here, I'm going to use that as a resistance level. Just looking at it going, okay, I don't know if it's going to run back up to 180. So I'm going to use this and dip my toe in the water. So I put that 175.20 with the dash dot line is my dip my toe in the water spot. And it was right around, I think it was right around 175 when the order triggered yesterday. So things were good this morning. Now it's rallied back up a little bit. And I actually looked at it. I said, you know what? It started to rally this morning. And I figured it would fill the little gap it had this morning. So I threw an order above the market to add to it, and it triggered. So I am I'm bearish on Apple. I hope it tanks. If you own it, I'm sorry. But that's what I see with Apple. Now, is that a recommendation to get short on Apple or sell it? No, it's not. In fact, you see, well, there was another thing too, not only the double top, but you could also look at this and say, here's a little tiny miniature head and shoulders. I don't love these little miniature head and shoulders when they're small. But they can work out beautifully. Let me give you an example. Lows, there's lows right there. That's like a 30 or 40 point move. Another one that was even beautifuler. Is that even a word? Beautifuler. NVIDIA. There's NVIDIA. Little miniature head and shoulders. I don't love it, but that was a 37 point move, and it danced around for a little bit, but then it finally cracked. And I mean, we dropped 300 to almost 200. So they can, even though I prefer a bigger one, these can still do well. So, but that is essentially my analysis on Apple. And you'll see, and here's the other thing too, that if the 50-day holds, then I might get stopped out of this thing with a hit. But it didn't hold last time. And if it doesn't hold, if the 50-day doesn't hold on this, I would expect it to come at least to 155, if not all the way to the 200-day moving average. And you can see, and this is one thing, you go back and look historically at specific charts and where they dig in, and you can see Apple all the way back. I mean, 220, there's the COVID crash. It broke it a little bit, but for the most part, it held the 200-day moving average. You can even go back into, 16. You can see that when it got above it, it even recognized it from the bottom, but when it got above it, it would bounce there. It recognizes the 200-day moving average a lot. And it just, when it consolidated, middle of last year, we came down to the 200, came down, danced, and then took off from there. So if this breaks the 50-day, as you can see, it did back here, right? It broke the 50-day, came back up, and it eventually the 200 caught up to it, but essentially dropped almost to it. So if this breaks and closes below the 50-day, I'm fairly comfortable that we're going to get all the way down to the 200-day, which will be about 150. The question becomes how long it takes. And if we get a big sell-off like this, it'll be fast, which would be great. I know for those of you that are bulls out there, you probably get a little cranky with me, but oh my God. This is the worst it's been. I haven't had the cough cropping up this bad. I'm getting too excited. Well, and this is one thing I was thinking too before we started, is that if the last year and a half you've been buying the dip, I think it's time to flip that script and sell the rallies. You literally, the process, everything is exactly the same, right? When you come here, and we'll take Microsoft on the left-hand side, right? You got this big rally up here. It kind of stalls out, but then it dips. And a lot of people started buying right here. It popped up for a couple of days, but then it rallied back. And so if it pops a little bit, if you get in a little early, that's okay, because maybe it falls off and then it retraces back and heads higher. Same thing, right? So this thing dips off for a couple of weeks, you buy the dip, and boom, it rallies. Stalls out here a little bit, comes back down, pulls back to the support level, buy the dip, boom, it rallies. Now you flip that over and do exactly the opposite. It drops off like this. When it rallies a little bit, that's when you start loading up on bearish trades. You start putting in just like you might start buying calls here, like this on this big drop here on Microsoft, right? You had a big down day. You might have bought calls, and for 3 or 4 days, you're sitting there going, yeah, maybe I shouldn't have, but you have your stop down here. Maybe I shouldn't have. And then boom, 5 days later, it takes off and heads north. Now you're happy again, right? Now you're bullish. We literally just flip it over. So if this thing rolls back down from here, you got some support at 280. If it holds that, if it does what it did here, then you can get bullish on it. Short term, at least. I still think this market's going to drop a lot, but we'll see. It's hard to tell. But Microsoft has definitely, I mean, you can see, and this has been a fun bunch of riding. And here's basically a triple top up here with Microsoft. And I've been in and out of this thing since that double top happened. And I mean, this is the trading plan I was following before. And now I must have just moved it on my intraday charts, but when it bounced and rallied back up here to 305, this 305 level, which is a previous resistance level, that's when I started adding to it. I started getting back in the bearish side. We've not only got you can see the trend that's been in place since the COVID crash, which it broke that in a big way. Just a couple of weeks ago, just got hammered, right? When the market did, and then earnings came out. And so it's been dancing around that level, around that 305 level, which is not only a horizontal resistance now, used to be support, but it's also the underbelly of that trend line. So I've been getting bearish on this thing, and who knows what's going to happen with it, but we'll see. So I don't know if that, who has to, oh, Robert did that. Whoops. Is that clear kind of what you're looking for, Robert, on as far as analysis with this? Microsoft, I guess it's, yeah, I've got it on my live chart, so I don't, which is weird. Usually I put the trading plan on here first and transfer it to toss, but I must have just been doing it there. So that's what's tricky. It takes a lot. It takes a lot of time sometimes to keep it all straight. It'd be nice to have just one place where everything is wrapped up into it, but unfortunately, that's not necessarily the case here. So, but this is Omega Charts is awesome. I've been using it for at least 15 years, if not 20, and it's just so easy to move around in. So we'll go see how things are going right now. IBM. What do you think? Get short this thing again? It's a 5-minute chart, but that's kind of tempting because there's definitely some support area right there. It's tempting to try to take another bite of the apple and ride this thing back down to 136, maybe even lower. It's got, and you can see down here on the bottom chart, IBM has some potential. The last time when it dropped here, it dropped from 137 all the way to 132. It dropped 5 points in the day. So a 5-point move, you know, you do day trade, just pick up 200 or 300 shares. You're looking at $1,000 or $1,500, but that's if, you know, it's always a big if. And who knows if the market's going to sell off today at the end or not. So BPS, that's the ticker symbol? Is that the oil company? Whoa, that's not what I want. BPS. What's it? Is it BP? Oh. Sorry, I wasn't even there. Oh, you have a bull put spread. You want the market to go up. Oh, are you talking about on Microsoft? I'm assuming you have a bull put spread on Microsoft, so you want it to stay above a certain price. That's understandable. I think yeah, exactly. I know where you're at. Been there many times. It's like, just stay above this price today. Just don't tank or wherever you don't want it to go. Bull put. So I'm not sure what strike you're at, and it really doesn't matter. So we'll look. We just got a few minutes left. We'll see. So here's Proctor Gamble. This is one that this is actually one I'm looking at a bullish trade on. Got a nice little symmetrical triangle. It could even be called an ascending triangle. So, and this is one that I did for pattern of the week. Also, another thing that I do in here is go back to the main screen. One thing I do is I record a video every week, and then they post it as the pattern of the week. So I find one pattern I like, my favorite pattern or whatever it is that I find that I think is good. And lately I've been doing at least two, usually a bullish and a bearish one. But there should be one up today of the pattern of the week, and this was one of them. So if you subscribe to Patterns of Flash, that's another thing you get with it. Not only twice a month do we do a live 1-hour class just like this, but you have the pattern of the week as well. So, and then you got the flashcards, you got videos, and this is all foundational stuff, the basics of trends, basics of candlesticks. So even if you're not new to charting, the foundations, 90% of my decision comes from the basic stuff you're going to learn in here. It's just like, just stick to the basics, right? That's what it is. But then there's patterns. You got price patterns, all the different patterns in here. There's videos anywhere from 3 or 4 minutes upwards of 20 or 25, I think, a head and shoulders that explains the patterns in depth, what we're looking for, what makes it stronger, what makes it weaker. There's over 8 hours of videos. Here's the bonus videos. Risk reward. That's the video I was talking about earlier. If you'll watch this, I get into it and you'll see the numbers. Quizzes. If you're not sure where you're at as far as your knowledge level goes with technical analysis, go take these. There's one for each of the 4 video sections. So dump the thanks, Clarice. Man, yeah, this is the worst it's been in a while. Maybe that means it's the end. So yeah, go grab the trial and take the quiz and see how you do. If you ace it, then maybe you don't need this, but there's always more to learn, right? So, but this is one that PG will be in there as pattern of the week. And then Pfizer's another one that this has got earnings coming up. So this is one that I'm just going to watch and see what happens with earnings, but another head and shoulders. So here's some from the past. ABBV was one. ABTR is one we've been looking at. BMY is one that has triggered. It actually triggered this morning. I was tempted to, but it was stayed there so quickly. It was so brief. That vertical line is where I highlighted this one on the pattern of the week. DWAC. I just saw somebody put that in there. Thanks, Kevin. Yeah, this is an interesting one. Last week on Benzinga when I was there, because I'm on there every couple of weeks for about 30 minutes, 45 minutes. And we're just picking brains. I don't know if you're all familiar with it, but we were talking about this. And this is, we have a nice little ascending triangle, a big pop here, right? Which this big pop came from Joe Rogan. There was news that Joe Rogan set up an account on Getter, which is, the Trump's platform, whatever you want to call it. Love him or hate him, he's setting up a social media platform to compete with Twitter and everybody else because people are getting cranky, for whatever reason. Well, Rogan set up an account and like 1 million people the next day set up just so they could access Joe Rogan. The guy's a monster. And that's part of the catalyst for this move. Well, it broke out and it pulled back and was looking at it right here at 65. Actually, that day right there, I had an order at 68 to go buy an option. But the spreads are big. The stock is wild. I day traded it a couple weeks ago, and a tick is like 50, 60 cents sometimes. And so it's wild and crazy. And I banked a little bit of cash, but I was upside down for a minute and I was kind of freaking out, but because it was moving so quick. But then it reversed. It was like, okay, I'm getting out. I'm gonna take my $330. I'm good. But yeah, it's a wild and crazy thing. So that came up on that show, and the gentleman that came up after me, I watched him and he was talking about this. And actually, I want to look at this. Shoot, we're out of time. I gotta talk faster. See, this is why I talk for so fast. If you look at the March, because this is a SPAC, right? If they don't approve the SPAC, then this guy's saying he thinks the stock's going back to 10, which I can see that as a possibility. And if you look at the March, here's the calls and puts, right? The call side, the open interest, this column right here. Look at all the open interest right here on the put side. Way down here at the $5, $10, $15, $20 strikes. There's a ton of people right now, because that's what this guy said. He said, if you don't think this SPAC's going to get approved and you buy puts down here, the 20s are 50 by 95 cents. You can throw $500, $600, $700 at it, buy 10 contracts. If you can get it for 70 cents, 75 cents. And if it doesn't get approved and it drops back to 10, you got $10 on that put option, right? So something to think about. So there's that possibility with DWAC that it doesn't get approved and it drops all the way back to 10. If it does get approved, I would expect it will probably rocket to the north side. But as you can see, and speaking of volatility, and this was one I thought about, is you can see the spreads on this thing are huge, right? Where's it at 85? So the at the monies are, that's even not that big. 1215 by 1270. That's pretty small. But then you got 985 by 975. That's $1. Too much. Too big of a spread. And even if you get in between the spread, if it moves fast against you, you kind of have to take it at the ask. And now you've got, so this is the kind of volatility that I usually steer clear of. one of the reasons I had that order out at 68 to buy an option, and I put a limit order in. And I wish it would have hit, because obviously 2 days later it's at 84 and the thing was almost double in price. I went and looked at it, which I shouldn't have, because now I'm like, it was like 470, or at least that's what I had the order in. It was like $9 or something up here. But woulda, shoulda, coulda. You miss them. You're going to miss them all the time. That's awesome. Thank you. Or Felicia. Thank you. I appreciate that. She said these flashcards have really, really helped. And I love the quizzes, which makes me stay honest with myself. And I appreciate that. It blew me away when I put these quizzes in there, because I hated school. I hated getting tested. It blew me away how many people said just that. These quizzes right here. And I love the quizzes because I hated tests, right? It boggles my mind. So, but no, I'm glad to hear that. I'm really glad to hear that. So, and I appreciate that. So, and that's exactly why I do this, to hear those things like that what I created is helping you get to where you want to go, wherever that is. So, Darla, real quick, let me grab your question and we're going to wrap up. So if you use options, the volatility could mess up your risk reward ratio. Yes, it could. Well, for example, like this here, if I'm day trading, I'm doing stock just because of liquidity, and it's easier to get in and out. There's so many benefits to doing it if you have the capital to do it. If you have to trade options, then, but again, options are leverage, right? They're double-edged swords. So you can make a lot really quick, but you can also give the market a lot really quick if you use an option. So, which you can do the same thing with stock. It just depends on, how big you're trading. So if you have the funds to trade stock, typically on day trades, I'm using stocks. But as far as the volatility goes, yeah, because if you got big spreads like this, and this is why, here's one right here. Look at the 75s. The 75 calls for March are 1470 by 1650. Even if you put it at, say, 1580 and they fill you with the spread, you're still a buck upside down out of the gates. And if it goes against you, this number is just going to get worse. So yeah, the risk reward ratio, I use the numbers and I use the price. Oh, that's, I think, what you were saying. I base that all off of the price. You got to understand that the options are derivatives underneath the price. So the options are going to move according to what the price does. But the volatility, when you see, that's one factor when you do trade options, is I make my decisions based on the price chart and what the chart's doing. But then you have to understand the basics of option, understand that the volatility, it can hurt you if you aren't careful with it, right? If you see a big spread like this, I usually just stay away from it. I typically won't trade it just because of the volatility and the damage it can do if it doesn't go in your favor. If it's got a tight spread and there's liquidity there, that's always good. So, but yeah, it's one of those things. And part of it's just experience and seeing things, like car, Will gained a valuable experience and seeing the volatility and how it can affect you in a weird way. And that's rare. It doesn't happen that often. So maybe I overstated it. I'm not trying to freak everybody out, but you do have to be a little more cautious, especially with things like DWAC or car that have big volatility. So, and if they have big spreads, like I said, I usually just steer clear of them because I don't want to mess with that. It's too iffy. And I've done it a few times and learned my lesson the hard way. So usually stuff like this, I don't get interested. I don't get into it. So, I can't remember the date. I want to say, Kevin's asking when they're supposed to decide on the SPAC. I remember hearing the date. I think it's in the either end of February or the beginning of March, if I remember right. I don't know. Probably the easiest thing is probably just Google it and see what it says. I didn't even look it up. I didn't think about it. Mainly because I'm not planning on trading this. Even intraday. I did it that one day and it was pretty wild and crazy. And I'm a little bit wild and crazy, but this one's a little more than I like even. So, and you can see, look at this. This thing opened at 81 this morning and it was 83 in the first 10 minutes. That's great if you're on the right side of it. And again, you can see yesterday here, it was 84 to 79. That's 5 points in 20 minutes. And these moves are not, like I said, this thing will move. That's 5 points in 20 minutes. Some of these moves are 50 cents on a dollar at a tick. When I say tick, it moves from, it sold here at 84.05. The next trade is 83.50. like that big of a move. So if you're on the wrong side, one tick just costs you 50 cents. So it can be crazy. So I usually don't play with these too much, the ones that are insane like this. Again, it's a double-edged sword. You can make a lot really fast and you can get hammered really fast. So I prefer the ones that they move fast, but they're a little more steady. Some of the more liquid, Apple's, Microsoft's, the Alcoas of the world have a lot of liquidity. Lots of people trade them. And so they move on a pretty regular basis. They may move fast and you get moves like this, but it's easier to get out and it doesn't move, it doesn't move 50 cents to the shot. It moves 5 or 10 cents or a penny a shot. So it's just easier to get out of the way if it moves against you. That's probably the best way to put it. You're not going to you might get, a little whack with a little stick, wooden spoon, but DWAC can hit you upside the head like a baseball bat. So do you want a baseball bat or do you want a wooden spoon? That's your comparison. I don't know if it's a good analogy, but anyway, appreciate y'all come hanging out. If you're not in Patterns and Flash Chat, grab the trial and come join me at 1 o'clock Pacific time, 4 o'clock Eastern time. That's just 4 hours from now, right? Is that 4 hours? 3 hours. 3 hours. So hopefully we'll see y'all in 3 hours and we will continue this conversation and look at more charts and do pretty much what we've done for the last hour. So you are welcome, Kevin. Thank you. Appreciate y'all coming and hanging out and having some fun. So y'all have a great day. God bless. Bye-bye.